There's a brochure on this desk. The cover shows a chart that climbs steadily upward. The numbers inside promise consistent returns. 20%, 30%, sometimes more, month after month, year after year, through every market condition, through every economic cycle. The brochure was given to someone they trusted, someone who already invested, someone who showed them the returns hitting their account. Proof, they said. Real proof. Money you can see. Today, the person reading this brochure is going to make a decision that will look completely rational. They will study the numbers. They will check the website. They will talk to other investors. They will ask thoughtful questions. And every single signal will tell them this is legitimate. But the entire thing is a lie. The people behind the lie will be gone. This is the story of how investment scams actually work and why they keep working on intelligent, financially literate people. Let's start with the most uncomfortable truth. Investment scams don't work because people are greedy. They work because people are responsible. The most common victim of an investment scam isn't a reckless person looking for a quick win. It's someone planning carefully for the future. Someone saving for retirement, someone trying to give their family financial security, someone who has worked hard for decades and wants their money to work hard too. That responsibility is exactly what scammers exploit. Because here's the truth about modern financial life. Inflation is constant. Living costs rise. Wages don't always keep pace. Traditional savings accounts often earn less than inflation. They're told they need to make their money grow. And then someone shows up promising exactly that. Consistent growth. Reliable returns, protected capital, the chart climbing upward. For someone trying to do the right thing for their family, the pitch isn't tempting because it sounds too good. It's tempting because it sounds exactly like what they were told to look for. That's the trap. Investment scams don't ask people to abandon their values. They ask people to trust the wrong vehicle for fulfilling those values. Every investment scam begins the same way, with a promise that sounds calm and confident, never desperate. Notice that. Real scams almost never sound like scams. They don't shout, they don't beg, they don't make wild claims. They make believable claims, slightly above market, consistently delivered, supported by what looks like serious infrastructure. The promise is usually one of these. Stable monthly returns of around 2 to 5%, modest enough to sound real, large enough to make a meaningful difference over time. Exclusive access to a private fund, a hedge strategy, or an insider opportunity normally reserved for high net worth investors. A platform that uses sophisticated trading algorithms, AI, or proprietary models that can outperform traditional markets without traditional risk. A relationship with a well-connected person, a former bank executive, a retired trader, a successful business person. The promise is engineered to do one thing: make the offer sound calmly believable to someone who already knows that real investments carry real risk. And in the early stages, the scammer's job is simple. Plant the idea. Stay patient. Let the victim's interest grow. Real scams move slowly at this stage. They let the victim convince themselves, because the most powerful sales pitch in the world isn't the one a stranger gives you, it's the one you give yourself. Stage 2 is where the scam becomes deeply convincing. The victim doesn't have to take the scammer's word for the returns. They can see them on the platform's dashboard, in their account statements, in screenshots that other investors share, sometimes even in actual small withdrawals, money the victim can pull out and hold in their hand. But here's the cruel truth about that proof. The dashboard is fake. The statements are generated by the scammer. The growth is a number on a screen, and the small withdrawals that work, those aren't returns from real investments. They're funded directly from the next victim's deposit. This is the engine of the most famous investment scam pattern in history. A scheme named after the man who popularized it in the early 20th century. A scheme that has been replayed under countless names, in countless markets, in countless eras. The mechanics are simple. Money from new investors is used to pay returns to earlier investors. As long as new money keeps coming in faster than old money tries to leave, the scheme survives. The dashboard always shows growth. The withdrawals always work. The trust grows. The investors share the opportunity with their friends. But nothing is actually being invested. There's no fund, no strategy, no portfolio, just one account fed by belief. The proof the victim sees is real to them, but artificial in origin. The victim's experience was authentic. The screenshots were real. The withdrawals worked. The dashboard updated every day. Their friends were doing it too. The lie wasn't in any single piece of evidence. The lie was in the entire system. Stage 3 is where investment scams scale. Once the victim trusts the platform, they start to share it. not because they're being asked to recruit, because they genuinely believe in what they've found. They tell their spouse, their parents, their siblings, their best friend at work. They post about it on social media. They bring it up at dinner. They become a quiet advocate for something that looks, to them, like a real solution. And the scam grows. This is the most psychologically powerful stage of an investment scam, and the most heartbreaking, because the victim isn't just being defrauded anymore. They're unintentionally pulling the people they love into the same trap. The scam uses this dynamic deliberately. Many investment scams target specific trust networks, ethnic communities, online enthusiast spaces. Inside these communities, trust spreads faster than skepticism, carries more weight than any advertisement ever could. This phenomenon has its own name in financial crime research: affinity fraud. It's the reason some of the largest investment scams in history have spread within tight communities. And the reason those communities are sometimes the slowest to discover the fraud, because no one wants to be the person who raises doubt about something so many friends are involved in. The snowball is real, and it almost always grows faster than anyone realizes. Stage 4 is where the scheme starts to strain. Sometimes the cracks appear because of external pressure. A skeptical family member quietly investigates and starts a conversation no one wants to have. Sometimes the cracks are internal. The scammer can't keep up with the math. The new investments aren't covering the requested withdrawals. Excuses start appearing. The signs always look the same. Withdrawals start taking longer than usual. The system is upgrading. There's a compliance review. The funds will be released after a small release fee, tax fee, or verification fee, then slower, then unresponsive. But here's the truly cruel part of this stage. They've invested heavily. Their family is invested. Their community might be invested. To admit doubt would mean accepting an unbearable truth, not just about the money, but about everything they recommended to everyone they love. So most victims at this stage do the most human thing possible. They send more money. The fees are small at first. The justifications sound reasonable. Surely after just one more payment, the original amount will release. Surely the platform isn't lying. Surely the scammer they've trusted for months wouldn't betray them after everything. This is when investment scams extract the most damaging losses, not in the original deposits, but in the desperate payments people make trying to recover the original deposits. They've seen this stage thousands of times. They squeeze the victim until the moment squeezing stops being profitable. Then they vanish. Stage 5 is when the truth finally lands. Sometimes the collapse is loud. A regulator publishes an enforcement action. A bank freezes the platform's accounts. The website disappears overnight. The founder is arrested. The story breaks publicly. Friends and family see the news at the same time. Sometimes the collapse is quiet. The withdrawals never come. The communications never resume. The platform stops working. The victim is left waiting for an answer that never arrives. Either way, the realization is devastating. For many victims, the financial loss is enormous. Retirement savings, not lost in a market, not lost in a bad decision, lost to a fiction that was wearing the costume of a real opportunity. But the financial damage is sometimes not the worst part. The worst part is the social damage. Many victims pulled their loved ones into the scheme. They have to face those people now. They have to apologize. They have to grieve together. Friendships strain. Family relationships fracture. Trust collapses inward. And the victim is often left blaming themselves. Should have noticed. Should have asked. Should have verified. If you're listening to this and any part of this story sounds familiar, please hear this. You are not alone. You did not deserve this. The system was engineered to make verification feel unnecessary. The proof was designed to convince careful people. The community pressure was orchestrated by professionals who study exactly how trust networks operate. What happened to you was a crime committed by experts. The fact that they fooled you isn't evidence of weakness. It's evidence of how sophisticated they were. So how do you spot an investment scam before it reaches stage 3 or 4? Here are the signals investigators rely on. Consistent returns regardless of market conditions. Real markets fluctuate. Real strategies have losing months. An investment that always performs. Through every economic cycle, every market correction, every global event, isn't an investment. It's a story being told to you. Guaranteed returns of any kind. No legitimate investment can guarantee a return. Real opportunities don't require secrecy. Real opportunities want regulatory clarity, not concealment. Difficulty withdrawing. This is the single most reliable signal. Every legitimate platform makes withdrawals as easy as deposits. Returns paid in ways real investments don't use. Cash deliveries, crypto wallets, personal accounts, gift cards, wire transfers to obscure jurisdictions. Real investments return funds through traceable, regulated channels. The opportunity came through a personal trust network, a friend's recommendation, a community member's endorsement, a religious leader's introduction. These contexts feel safe, and that's exactly why scammers use them. The recommendation isn't proof of legitimacy. It's proof that affinity fraud is working. When you see two or more of these signals together, pause. Verify with an independent licensed financial advisor. Check the platform with your country's securities regulator. Search the name with the word scam attached. Most importantly, ask one question, kindly, of the person recommending it. Have they ever tried to withdraw the full amount? If they haven't, they don't know what you don't know. If this episode reached someone today who needed to hear it, that's exactly what this channel was built for. Investment scams thrive on confidence. The confidence of a polished platform, the confidence of a trusted referrer, the confidence of seeing the numbers grow on a screen, the confidence of feeling responsible while quietly being deceived. The defense isn't suspicion of everything. The defense is verification of anything that matters. Subscribe to Money Crimes Decoded for weekly deep dives into the hidden side of financial crime. Every week we cover one new red flag. Every month we go deeper into one major pattern. And every episode is built to help you see clearly in a world designed to keep you distracted. In the comments, if it feels safe, share an investment pitch you've encountered. The patterns, the language, the promises. Someone reading those comments may recognize a pitch they're hearing right now and step back in time. Until next time, keep your money close and your verification closer.